All right. Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, I'm super excited to be talking to a man who knows quite a bit about that topic, Mr. Emanuel Datt from Datt Capital. Today, we'll be talking about a little bit of macro commentary, our classic ROI segment, where Emanuel is going to share with us one of his highest conviction investment themes moving forwards. And I know you're going to get a lot out of it. So like and subscribe to the channel, guys, and stick around for some investing wisdom with my fantastic guest, Mr. Emanuel Datt. How are you, sir?
Yeah, thanks for having us, Benjamin.
My pleasure indeed. And so what I really like about your interviews is there's no fluff. You really get straight to the point and just deliver knowledge bombs. So if I get you to just give us a little bit, maybe 1 to 2 minutes about yourself and the fund that is Datt Capital, listeners would be very interested to hear what your investment process is, and in particular, who is your ideal client?
Yeah, absolutely. So I've been running a fund at Datt Capital for just over 4 years now. Since that time, we've returned a compound annual return of 22.47% net to our investors since inception. So we've managed to perform through what rain, hail, and sunshine of the past few years in multiple markets. In terms of investment style, we're long only, sector and market cap agnostic. So we truly have an unconstrained mandate. In terms of our fund objective, is to deliver a minimum 10% return to our investors each financial year effectively. And in terms of our ideal client or our existing client, yeah, we are a wholesale fund. So we tend to deal with sophisticated or wholesale investors, which is just really a fancy way to say someone with a higher than typical high net worth, I should say. Yep. And our client base is generally people who are generally a little bit older, affluent professionals, sort of in the twilight of their career, or retirees who appreciate the value of having a differentiated active funds manager in their sort of portfolio. So that's a little bit about my business and how we operate effectively.
Fantastic. And those returns certainly prove the value of a quality active manager, as you say. And we'll have the details in the description. So anyone who's listening, if that sounds like you and you want to get in contact with Emanuel, the link will be in the video description. Quick question on the fund. Is it an Australian only fund? You mentioned it's long only. It's a domestic fund. Is that correct?
Yeah, that's correct. So we have a typical managed fund structure, which is a unit trust, and we invest solely within Australian markets. So not investing in US stock or anything, solely stuff on the ASX primarily.
And I noticed year to date, the ASX is down 7%. So there'll be plenty of people out there looking for some alpha or outperformance in finance speak. I'd love to get your thoughts today on just a brief overview of where you think we are in terms of the macroeconomic cycle. Inflation seems to be making the news. It's a hot topic for people. How are you positioning your funds and the funds of your clients to protect that capital and potentially grow that capital during turbulent times of inflation and rising interest rates, which of course is really tricky for equity investors because it increases that discount rate and cost of capital?
Yeah, absolutely. So I think inflation is here to stay for now. I think a lot of it really comes down to just the ultra low unemployment rate that we have today. I always remember when I was in uni, we were always taught that full employment was considered to be at the 4 to 5% unemployment rate, and now I believe it's in the high twos, which is really unprecedented, and I believe it's the lowest unemployment rate we've ever seen, or for many decades in Australia at least. So I think that in many ways that's really the primary driver of inflation at this stage. I always have the caveat, always add in for now, because we can't. I think it's quite unreasonable to forecast these particular metrics or measures a long way forward. So for now, I mean, 3 to 6 month sort of time horizon.
So much can change. You have a change of government, have change of policies,
exactly.
or who knows what. COVID has taught us to shorten the horizons, I suppose.
Yeah, absolutely. And so, accordingly, I think interest rates locally will continue to rise for now. And, I personally expect that we'll be seeing 50 basis point rises each month until the end of the calendar year. And then I'm sort of expecting maybe the RBA might pause, because that's, still, I mean, we've got, I think, another 3 before the end of the calendar year, which will be another 1.5% on, so that might get us to, over 4% in terms of the RBA rate.
Does that concern you at all in terms of, I know there are a lot of investors out there that kind of took the governor at his word in that he would continue to keep things on hold until roughly 2024. The bond market obviously was kind of calling a bluff there. And as we've seen, I guess the RBA is caught in a really tough place. They either stick to their previous word, or they kind of trash the Aussie dollar if they stay behind the raising of rates in the US. How much of a concern are rising interest rates for you in the way that you invest?
I don't think it's a great concern for us. Primarily, we've seen such incredibly low base rates for interest rates themselves over the past 3 years. So, I've invested in periods where interest rates are normalized, and I think that higher interest rate environments actually benefit skilled active managers. So I was
going to ask about that.
I'm not afraid of investing in these particular environments, and I think that your opportunity set actually grows as you see multiples do come down over time, and in line with interest rates. But also, I think the best way to think of it is that if you've actually got a true opportunity cost, say if interest rates are at 5%, you can probably earn a decent return parking your cash in the bank. You don't necessarily need to take market risk to earn a low single-digit percentage on your funds. So I think that really flows through to listed instrument, the pricing of listed instruments broadly, in the sense that of being a bit of a lead balloon, so to speak, that's where the opportunity lies, I suppose.
Yeah, it's an interesting perspective to say that perhaps for a guy like you who's extremely value orientated in the way that you invest, that falling prices are obviously a good thing. And if we have rising cost of capital, but if you're getting high free cash flow yields on the investments that you're making, then so much the better. How much of your investment philosophy with Datt Capital is top down versus bottom up, in terms of top down looking at what may or may not happen from a macro perspective, versus bottom up of saying, I don't really care what happens in the macro in the short to medium term. I'm just looking at the balance sheet, the income statement, the cash flow statement to see, does this investment stand on its own, and am I happy from a fundamental perspective?
Yeah, sure. Well, I think the right answer to that question is that you really have to adjust to the market. A rule of thumb that I like to use is that 50% of any return is generally derived from the market, and I'd probably say another 30% is derived from the actual sector exposure, and only about 20%, I believe, is from the individual stock itself. So accordingly, in fairly benign, flat to gently rising market conditions, you can very easily take solely a bottom-up approach, as markets and sectors would typically have a slight upward bias in these benign conditions. However, in rocky markets, I feel it's much better to shift your approach and take a more top-down approach in these instances. And that allows you to proactively invest in thematics where you can really prosper throughout market volatility. And it's more of a you really need to pick the right sectors in downward markets to be investing in.
And so is it fair to say that during these benign economic times that rising tide will lift all boats, and so you can get away with maybe a broad ETF or something like that, and people start to think, oh, well, what do I really need an active manager for? But precisely now, where the future is not going to resemble the past, this is where an active manager really earns his or her stripes in being able to protect capital and narrow into those niches that you mentioned in order to safely steer the ship. Is that fair to say?
Yeah, absolutely. And I think as we came out of the COVID downturn, I remember there was huge discussion and significant discussion in the media questioning whether active managers are still relevant, and why don't we just why don't all investors just invest in ETFs that or tailor their exposure via buying various ETFs? But I think that consequently, we've definitely seen the value of skilled active managers, and of course, then comes the question of you have to really pick the right active managers as well, because not everyone. Yeah, exactly. Everyone performs differently and according to market conditions. So I think that the value of active managers has definitely sort of is back in the forefront of investing public's mind again.
Yeah, it will certainly make for interesting times. And now it's time to shift to our ROI segment. So it's ROI time, guys. Emanuel, I have to ask you, what is your highest ROI from an investment to date? And moving on from that, if it's different to your highest conviction stock, I'd love to hear about your highest conviction stock currently. And disclaimer, guys, anything mentioned on the channel is purely for information and entertainment purposes. It's not to be construed as financial advice.
Absolutely. So my highest ROI from an investment to date was, ironically, it was my very first investment in a resource stock. And this is going back to the year 2006 when I first started investing. I actually 13 times the stock. And it was really
not bad for first investment.
Oh yeah, it was my first resource investment.
Okay, understood.
But it was really a mixture of observation and pure dumb luck. And so effectively, I'll give you a brief story of what
Absolutely.
happened. So effectively, it was in a company called Alliance Resources that is still listed today, and they were in a joint venture searching for uranium with a big US uranium player called Quasar, I think it's pronounced. And so effectively they were running an exploration program, and they had put out some good uranium results. And at that time, I was reading, I was still learning about the sector itself. Uranium was on my radar, and I'd been reading, for some days, results of uranium players out there that are putting out results. And basically, I cottoned on to the fact that, these results are about 5 times the grade of other companies that are putting out results. So I bought in purely on the back of that. And thankfully, the follow-up results were twice as good as the set of results that I'd bought on originally. And the stock flew from, I bought in at about 20 cents or so, and sold out at about $2.50 or $2.60. And this was after maybe a year or so of holding the stock. And thankfully so, because the heat came out of uranium shortly after, and there were other issues within the company and the joint venture itself. So, and that was sort of what really got me hooked on resources. Effectively, it's hard to describe the rush and the feeling of your first big win, especially when you're in your early 20s. And it was life changing.
I can see the glint in your eye as you reminisce. Now, many people believe we're heading towards another commodities bull market. I know that
Mhm.
you have a very high conviction play that is in the commodities sector. Would you mind
Mhm.
telling us a little bit about that? What attracted you to it? Why you're invested, and any other details that you might tell us to give us more so an insight into how you think about approaching these investments.
Sure, absolutely. So our highest conviction stock at this juncture is Whitehaven Coal. The ticker on that is WHC, as listed on the ASX. So effectively, Whitehaven Coal produces high quality thermal coal, which is used in basically to generate electricity. It's pretty much 100% focused on exporting this to East Asia. So Japan, Korea, Taiwan, these are where Whitehaven's customers effectively are located.
But they don't sell to China, is that correct?
Yeah, correct. They don't have any Chinese exposure. So, we think that Whitehaven produces some of the highest quality thermal coals globally, but yet it's priced at about just under 2 times post-tax free cash flow, which is incredibly cheap. If you were looking at a tech company or a company in virtually any other sector, you'd be mad not to buy it at the year, or be a take private proposition effectively. So and I think that is just quite incredible, because you look at the company, and if it's trading at, say, 2 times free cash flow, that basically implies that there's no residual value or terminal value in finance terminology, being incorporated in the current asset price. And this is despite Whitehaven's mines having a life of mine, or an asset life, of over 20 years. And it also totally ignores that they have more demand than they can supply effectively, because it's high quality products are quite scarce, and we actually expect demand is going to escalate going into the end of the calendar year. And this is due to winter coming up in the Northern Hemisphere. I should probably point out that 90% of the global population lives in the Northern Hemisphere. So this is obviously going to be a peak, or we're going into the peak season, into the winter there. And I think that it's quite possible that we see stronger pricing on the commodity side. In terms of risk factors, I guess the risk factors would be on the political side. But however, we've seen the federal government, federal Labor government, come out with rhetoric saying that there'll be no impediments to export-related energy resources to key partners. And Whitehaven's customers are obviously key trading partners of Australia's economy. So we're not expecting too many hiccups as such there.
There were a few people worried about Queensland changes to legislation, weren't they, with regards to coal mining?
Yeah, absolutely. So that could be a possibility in New South Wales. But I think that at this stage, it's not likely. But then again, it's one of those externalities that you have to account for, even though you may have a strong opinion that it may happen, may not happen. I think at 2 times cash flow, or just under 2 times cash flow, you've got a huge margin of safety in any regard. But I think a really important aspect is that the company aggressively returning capital to shareholders via a mixture of dividends and buybacks. And so, in a nutshell, it's an incredibly cash generative, high margin business that's trading at just rock bottom valuation multiples. And I think ultimately that is the best protection against inflation.
I couldn't agree more.
situation.
And it's interesting to see that return to shareholders has been rewarded by the share price. It's been on a tear over the last 18 months or so, let's say. However, what I pick up from your language is that you're talking about the valuation of how much you're paying for the cash flows. And just because the nominal share price may have increased or decreased in the meantime, that's not what you're looking at initially. You're looking at the ability of the company to generate cash into the future, discounting it back to today and saying maybe the price has gone up, but it may actually be cheaper than previously, depending on its ability to perform. So my question before we leave is, with this supply disruption to energy producing commodities, particularly with regards to thermal and manufacturing needs, the Germans are looking for firewood in the forest at the moment to try and get ready for winter.
Yeah.
The demand set for decades out into the future. How is it possible that someone is able to look into a publicly listed company and, with these so-called efficient markets, be able to pick up an investment like Whitehaven for such a low valuation? What do you think is stopping the capital flows from normalizing the price?
Yeah, well, I think a lot of it ultimately comes down to ESG considerations, or widespread ESG considerations in the local market. I believe that Whitehaven's share register is becoming increasingly international. And I think that the awareness of this stock on a global basis is, I've noticed, I talk to investors from overseas, for example, and they're just incredulous about the valuation of Whitehaven as a company on Australian markets. They can't believe that it's so cheap. And we, of course, are in the same boat. But, we think that, the question is, how does this get revalued to where it should be ultimately? And I think that the company returning capital to shareholders aggressively is a key part of that aspect in terms of achieving a higher valuation. So I think the company has bought back almost 10% of its register to date. And I think the buyback started early on this calendar year from memory. And so we're definitely sort of expecting that the company will continue on with its path of pursuing buybacks. And they're buying back shares at less than 2 times free cash flow multiples. So it's highly value accretive to long-term shareholders. And this is an investment, even if the coal price of the price of coal retraces back 50%, I think it'll still be incredibly or look like incredible value at current prices.
And do you expect any multiple re-rating, or do you think that perhaps with ESG being what it is, this stock investors might not be willing to pay up for a multiple of the cash flows, but if you're going to earn your way out of the investment through free cash flow in 2.5 years to 3 years, let's say, you're fairly comfortable with the returns in any case?
Yeah, absolutely. I think there will be a multiple re-rating. I think just the sheer aggressiveness of the capital returns will ensure that. And why I say that is because, there is going to become a true, there already has been, I guess, a true opportunity cost of not holding Whitehaven and other coal players, I should add. And I've observed, I invested or re-entered Whitehaven probably about a year ago. And I think at that stage, we're one of the few Australian investors beating the drum on how cheap it is, and really pitching the market fundamentals and the attractiveness of the opportunity. And over time, I've noticed more and more generalist investors entering the investment as well. And I think that's great, because ultimately it's played out exactly as we thought. And we always thought that eventually it's just going to be too good to ignore. And that's what seems to be playing out. I think it's gone up almost 4x since we first started buying in the mid-2s. And it's been a great investment, and I think it will continue to be a great investment.
Absolutely. Well, that's a fantastic ROI concrete example for the ROI channel. Thank you very much for joining me on the show, Emmanuel. I would love to stay and chat with you all day, but I know you're a busy man and I've got to let him go, guys, or he'll never talk to me again. Guys, moving into the current environments, if you're looking for an active manager to add value, you may want to get in touch with Emmanuel and the team at Datt Capital. Details will be in the description. I hope you enjoyed this episode of the ROI channel. Leave your comments in the comment section, and I hope to see you in another episode shortly.
Thanks,
Take care, everyone.